guys, welcome back. This is Pietro Terzano, creating video content for Savius US. Before we get started, I want to just remind you that I'm not a financial advisor, so I'm not here to give you any suggestion about how to invest your money. On that, you should make your own decision and do your own research. I'm just here to create video content with a scope of possibly ping you to study some more in the right, put you in the right direction, what I think is the right direction. Maybe generate a few discussion and some trading analysis and ideas. But again, I'm not a financial advisor, so just keep that in mind. So today we are going to talk about contango and backwardation. What are them? It's not an Argentinian dance, South American dance. Contango and backwardation is like, oh yeesh, I want to walk backward in time and just try not to add that extra chili in my tacos, because that was an awful decision. No, we are referring just to the shape of the futures market, the shape of the curve. So as I said in some videos in the past, one of the main characteristics of the institutional traders or investors is that they tend to look at on a longer time frame, and they tend to trade the curve. Even right now, as I'm talking to you, I'm here at home. I have my 4 screens, which are not enough. I'm gonna need to add another 2 very soon. But anyway, even now I'm trading, and I'm trading the whole curve, not specifically the front month. It's so much easier, and in a way to put some trades on, some trading idea on a way, of course, because you can spread your risk according to your analysis that needs to be macro. So how do I look at the shape of the curve? What does it tell me? Of course, we have to go back to the basics. So how the futures, what is incorporated in the futures price? So the future of, for example, a commodity, you have the spot price, so what you can buy today on the market spot and be delivered, and then you have the future price. And the future price will be determined by the current price, the cost of storage, the cost of insurance, interest rate, and of course there is a bit of expectation of where the price will go. So naturally, the price of a good or a commodity for the forward months should be higher than the spot price, because to sell it, forward, you will need to have all these costs applied to the spot market. But that's not always the case, because there could be events that could reverse this curve. Somebody like to call it the inverted curve, but it's not totally right when referred to commodities, more referred to interest rates. But inverted curve means when the spot price or the front month futures price is higher than the following month. So suppose now we are in October. If November price is higher than December price, it means the curve is backwarded. Why could it be that November is higher than December? Because something happened and the demand for that particular good or service is so much higher now that you want to buy now, the prices are skyrocketing, and then it becomes higher than December and January, etc. So the other way around instead is when demand is low or is normal, and so you have the following month's prices which are higher. So the shape of the curve could be like this, like going up like a steep rise, or the other way around. So we have backwardation like this, and you have contango like this. So even in my market, this situation, there was a major curve shift, and when it shifts the whole curve. Then there are also some seasonal patterns that could make a weird shape of the curve going forward. Maybe you have a grain season, and for a series of reasons, that second quarter of 2023 is higher than the first quarter and higher than the third and fourth quarter. So the curve could be shaped like this, like a sinusoidal, instead of being a straight line with a certain slope. But there's surely a way to look into that, and that philosophy can be also used to identify major macro trends. Why sometimes you get stuck and look at what happened on the daily basis, on the weekly basis, or you want to check the chart. We look at the daily chart, we look at the weekly chart, and we lose focus on the shape of the curve. What is the contract for September versus the contract of December versus the contract of March? For example, the S&P 500, what's the shape of the curve? Take a look, for example, at VIX Okay, the VIX index, the fear index. There is an excellent website, it's called VIX Central, if I'm not wrong, and then you can check the VIX curve, the curve of the VIX futures, and that tells you a lot about this market sentiment. What is the shape of the curve? Is it in backwardation, so there is high demand for VIX futures now, people willing to cover, to hedge, or is the vice versa, the other way around, so the curve is in contango, so there is no fear now, so here the price is lower than later. That's, if you go there, you can play around. There is, I think, you can set your dates, and you can go back and forth in time. You can check what happened in 2008. How was the curve shaped back then? What happened in 2020? How was the curve shaped back then? And that tells you that then you compare to nowadays situation, and what does the VIX curve shape tells you about the current market situation, what is expected. The shape of the curve is also difficult to trade, sometimes could be a pain in the neck. I don't know if you're aware of what an ETF is, I suppose you are, but some VIX ETF could have trouble in trying to track the index using futures, for example, because when the market is super bullish, what happens? The VIX on the front month will be very low, VIX on the next month will be very high. But futures have an expiration, so before this future expires, you need to roll this position into the next month. But what happens when you sell this and you buy this? You sell cheap and you buy expensive, so you're locking a loss, you're losing, and then at a certain point you will need to roll this position into the next month. But guess what happens again? This future will erode its value because the volatility of the spot is low, and so this future slowly its value will try to reconverge towards the spot and lose its value until you have to roll. So of course there are methodology, there is a so-called smoothing out, so when they rule part of the position on a daily basis, and there are a few techniques to smooth out this effect, but some of these VIX ETFs not always work as well as you might expect in turbulent times, just because that contango is huge, because people want to buy protection, so and there is no demand for cover now, but something could happen tomorrow, so I want to have my cover. So the curve shape is like that. So that's why these ETFs sometimes they're not working as well as they should. So I believe that's an example of a few of these applications of taking a look at the curve. But I do really encourage to start looking at the curve shape or whatever is it you're trading, whether it is grain or interest rates or the S&P 500, whatever. That's a must. Start looking at that. Start having a more institutional long-term approach, and that doesn't necessarily mean that you can trade this on your day trading or intraday sort of approach, because I understand not everybody has the market, has the money to place a trade and use a large stop, but it's useful. That being said, my biggest let's say suggestion in general would be to use the smallest leverage possible for your speculative trading, because I believe that the most valuable type of analysis is the one you get by your experience, but in order to get experience you need to stay alive. So using low leverage will sort of help you stay and survive a lot longer on the market. Not talking about your savings, but especially your savings, but when you decide to use part of your savings for speculation. Okay guys, I think that was a sort of a short video, but I believe that gave you sort of idea, something to think about. So the last three videos we discussed about martingale, we discussed about seasonality, and now we discussed about the shape of the curve, which fits very well into seasonality, because the shape of the curve could change and you can start playing those spreads of the front month contract versus the forward months and sell one, buy the other, because you expect a major shift in the curve, right? So that is how the time spread works. So try to connect the dots and see that we're looking slowly putting together a puzzle of what you should be looking at when putting together a strong analysis of your market. I'm running a bit low voice here, so I think it's enough for today. I'll see you next time. We're probably gonna talk about reversals and corrections. I haven't made up my mind yet, but we'll probably go into that direction. Okay guys, thank you very much. Stay safe, stay cool, and keep the leverage low. Bye.